I finally got a haircut so you don't have to deal with big hair Mark. But today I want to talk about the 10 banks that are most exposed to uninsured deposits. And this is an Investor's Business Daily article, which I can leave a link down below in case if you want to look at it, because we're going to show a lot of information in this video. And there's also a renewed fear on the European banks that are sending the markets down today. And so I just think this is a good thing to cover because there's a lot of you that I know hold bank stocks. I just sold my Bank of America position, which I will leave a link down in the description as well of that video, because I make some good points, I feel, on why I am just staying out of the banking sector altogether. So let's get started with this video and let's talk about the 10 banks that are most exposed to uninsured deposits. So this article starts off by saying there's high levels of uninsured deposits that helped do in Silicon Valley Bank and Signature Bank, but it turns out they're not alone. Dun, dun, dun. So there's 10 banks owned by U.S. listed financial companies, including Bank of New York Mellon, ticker symbol BK, Northern Trust, which is ticker symbol NTRS, and Citigroup, which is ticker symbol C. Now, Citigroup, I bet you are surprised to see this on here. This was a big buy by Warren Buffett last year in 2022. So a lot of you may hold it, as I think people like to follow his investing strategy as well. So these are among those with the highest percentage of domestic deposits that are uninsured, says a new analyst by S&P Global Market Intelligence. Failed Silicon Valley Bank and Signature Bank are two of the 10 firms S&P Global Market Intelligence identified. So you'll notice I highlighted twice S&P Global Market Intelligence. Now this looks a little familiar and I wonder why. Oh yes, this is one of my newest stocks that I bought that I am very bullish on. So this will lead us into the segue of looking at my portfolio performance. This is something I show with every single video. I'm very transparent. If you like that type of content, be sure to subscribe. But on the top right, you'll see in the financial sector, all alone is SPGI. And what I will say is I did not seek out this article based on an S&P Global Market research. I was looking at this article, found it interesting, and saw that it was put together, a lot of the data by S&P Global. And I think a lot of people don't realize how much of the market, the economy intelligence, comes from S&P Global. And one of the reasons why I'm so bullish on it, but I did do a separate video, so if you're interested, just look through my channel, find it, and you can watch that. But my portfolio is down almost 2.5%. That's almost $1,400 in the red. Really what's holding up my portfolio right now is Microsoft and Meta. Yes, Meta is coming to the rescue with all of this talk of banning TikTok. And of course, the CEO of TikTok's going under the microscope right now with lawmakers and politicians that are questioning them, wanting to ban this company. It's really helping to boost up Meta. But a lot of these stocks have gone down that were up for me pretty significantly, such as Vici. They're only up 4.5% now. SCHD is only 3% in the green. So definitely some buying opportunities, I feel, and I will be taking advantage, and there might be a big change by next video, but we'll see. So let's get back to this article, and it says insurance from the Federal Deposit Insurance Corp, or FDIC, guarantees bank deposits per institution per person up to $250,000. A lot of you may know this, but if not, this is very important. You are insured when you put your money and deposit it in a bank up to $250,000. In case if anything happens to that bank, you'll get your money back. Anything above that is uninsured and you are at risk of losing it. Now, a lot of people think they can open up multiple accounts within the same bank and have each account below $250. That's not how it works. You have to have it with different banking institutions. So just be sure to remember that. Some bank clients, for various reasons, leave more than $250,000 deposited at banks, and the FDIC does not officially insure such excess deposits. Such exposure spooked Silicon Valley Bank customers, and depositors demanded their money back in a classic bank run. So yes, there's people with millions of dollars, probably not any of us that are watching this video, but if so, congratulations. But for those with millions of dollars, they definitely have to spread their money out. And probably, I don't know if you can buy extra insurance, how that works, but for us that have below $250,000, we have nothing to really worry about if we hold it in big banks. But I will talk a little bit more about regional banks. So The Silicon Valley Bank and Signature Bank had some of the highest proportions of estimated uninsured domestic deposits across the entire industry. So let's look at the bank's uninsured deposits. Events at Silicon Valley Bank brought to light the unexpected risk to banks with such high degrees of uninsured deposits. It doesn't take much to trigger a stampede of depositors firing up their banking apps and trying to transfer money out. Now, I highlighted banking apps. This is something that's newer within the last 5 years. Before, it was a lot harder. You had to go to a physical branch to take out your money, but now it's almost instant. You get on your banking app, you can transfer funds in and out as needed. I do it all the time. So I think this adds a level of risk, especially for those banks that hold high amounts of uninsured deposits, and something else we're going to get to here in a minute. But just keep that in mind that the banking apps are making transferring of money easier than ever, which really put the pressure on Silicon Valley Bank and Signature Bank and others currently. So uninsured deposits surged at many banks in the wake of the pandemic. So of course, when the pandemic hit, what did people do? They sold out of their investments and put their money in banks, and that's what happened. So large US banks held $7.9 trillion in uninsured deposits at the end of 2022, up nearly 41% from 2019. The level in 2022 eased from 2021 as people found better places to put money than in banks. Of course, we had the rates go nearly to zero, so putting it in banks really didn't make sense at that point. But what happened? I put here stock market. People invested like never before. We had a huge bull run. Of course, I think a lot of people invested in not a smart way because they were newer to investing and everybody else was doing it, so they decided to do it and they put it into speculative tech stocks, which kind of is a hint at Silicon Valley Bank. But this is why we saw that ease after the pandemic, because people saw that it was easy money in the stock market and it attracted a lot of investors at that point. So Silicon Valley Bank ranked second among banks with more than $50 billion in assets, with 93.9% of its total domestic deposits being uninsured. That is an astronomically high amount. While Signature Bank ranked fourth according to the S&P Market Intelligence data as of the year end of 2022. So Silicon Valley Bank, they had this high amount of uninsured deposits, I think because of their customer base, it's these tech companies, but also you had all these investors putting their money into these tech companies, which boosted up the amount of money they had that they had to put in banks, and Silicon Valley Bank was one of the common ones for these tech stocks. So looking at the banking landscape, highlight some other banks with high levels of uninsured deposits. Only 3 other estimated uninsured domestic deposit rates above 80%. All 3 are Bank of New York Mellon, State Street Corp, and Northern Trust Corp are large trust custodial banks. So there's still large banks out there that are at risk. Now, uninsured deposits are only half the story. We have to talk about the other issue that happened here, and that is that banks have a high level of securities that are being held all the way up to maturity compared with total deposits. This reliance on long-term investments made it difficult for Silicon Valley Bank to sell and raise capital fast enough to meet the swelling withdrawals from depositors. So just to pause real quick, I'm sure a lot of you have already researched this, but Silicon Valley Bank, the problem is, and banks in general, they do this. They invest customers' money, and what Silicon Valley Bank did and these other banks that are going under is they invested in long-term securities, 5 to 10 years, which if someone's going to pull out their money before then, they're going to have to sell those securities. And with the current conditions, when they bought back initially, it was at low yields. Well, of course, the Fed has raised rates pretty significantly, and what that did is made those securities with the lower yields go down in value. And because they couldn't hold to maturity, because all these people were pulling out, they had to sell at massive losses. So really, these banks weren't adequately diversified in liquidity with their different investments. They put most of it in long-term securities, which was not smart. So when compared to Silicon Valley Bank and Signature Bank, the trio, which is Bank of New York Mellon, State Street, and Northern Trust, had much lower ratios of total loans plus held to maturity. So that's good. So there's these 2 things we're looking at: the total amount that's uninsured above 250, and those banks that have way too much money in long-term securities. That if they had to pull out now, they'd make massive losses. So for instance, Bank of New York Mellon's loans and hold to maturity securities are only 31.2% of total deposits. And that percentage is only 40.1 and 54.5 at State Street and Northern Trust, respectively. Compare that with the nosebleed levels of 94.4% and 93.3% at Silicon Valley Bank and Signature Bank. So again, they had the high uninsured deposits, but also they had most their money tied up with long-term securities that they couldn't really touch, but they had to, so they had to sell at losses because of everybody wanting to pull out their money. So America's oldest bank, BNY Mellon, has a strong, well-capitalized, and lower credit risk balance sheet with $406 billion in total assets as of year-end 2022, out of which $197 billion are in cash and other high-quality liquid assets with a loan-to-deposit ratio of 24%. So healthy banks will have money in cash or high-quality liquid assets in case if people do want to pull out their money, they can fulfill that need. Where Signature Bank, Silicon Valley Bank didn't have that. They had it in long-term securities that they had to sell at losses because they couldn't wait to hold them till maturity to get back that money plus the interest. So understanding the risk at banks. That's not to say that some banks don't have high exposures to held-to-maturity securities. Two do. Only two banks with more than $50 billion in assets and at least half of their domestic deposits estimated as uninsured had total loans plus held-to-maturity securities that exceeded deposits at year-end 2022. First Republic Bank had the highest at a staggering 110.6%, while Western Alliance Bancorp's subsidiary, Western Alliance Bank, was at a staggering 101.7%. That is ridiculous. But it's important to note that First Republic and Western Alliance also have much lower levels of uninsured domestic deposits. So they have kind of one issue, but not the other. And they're at 57.7 and 67.7% of those uninsured domestic deposit percentages. So keep in mind also that the rules have kind of changed to offer safeguards for the big banks, but regulators also said that depositors at Silicon Valley Bank and Signature would have access to their funds. The move has not completely taken the panic out of this system, as bank stocks were battered since then and still are, and of course we're having this newly developed European bank issue, fear. But what they did is they said, okay, these big banks can really affect the economy. They have a lot of influence, so we're kind of just going to say we're going to make sure everyone gets every penny they have in those banks. But what about regional banks, these smaller banks that might not have as much influence? I'm going to talk about that in a minute, but let's now look at the chart showing all 10 banks with the highest uninsured deposit balances, but also loans and held-to-maturity securities relative to total deposits. Of course, the higher the percentage, the worse they are, the riskier they are. And you'll see on the very left, the two companies I highlighted are SVB Financial Group and Signature, the ones that started this all and are having the main issues. Anything circled in red is high risk and extremely unhealthy. Anything in yellow is kind of a moderate risk, and anything green is acceptable. So of course, SVB Financial and Signature, I circled in red both sections, where the others you'll see have at least one red, one green, one red, one yellow, and then so on and so forth. But the 10 are Bank of New York Mellon, the SVB Financial Group, State Street, Signature, Northern Trust, Citigroup, HSBC Holdings, First Republic Bank, East West Bancorp, and Comerica. So if you are invested in any of these banks, it might be wise to think twice about it, because any added pressure, these banks are going to suffer the most, and they probably already have. And if you're down massively, you need to really look into these, research them, and see what the risk is of selling now versus maybe waiting and seeing what can happen long term. But you should watch my video on Bank of America where I sold that stock, because I talk about why I just don't want to hold banks anymore. But also, if you do have your money in one of the big banks like Bank of America, Wells Fargo, JPM, you are fine. They are mainly composed of customers with less than $250,000 held in their accounts, which is less risk as they fall in the insured amount range. These big banks have a lot of people that hold under $250,000, which is most of us. They also diversify their investments and have diverse liquidity options in case of the very unlikely event that a large amount of customers want to pull money out within a small time frame. So the big banks are very healthy, they're very safe. I have no concerns with them, but the regional banks, I'm a little concerned. I think they're more risky currently, as customers might want to move money to the big banks as it will make them feel more comfortable and safe with their deposits. And my big question is, will the government protect these small regional banks like they did with the bigger banks like SVB, Signature? This is what many local politicians are questioning the government on, and I feel it will only lead to the big banks winning and taking up more market share, hurting the little guys and causing some small banks to go out of business. So let's face it, these small regional banks, if they start to have this liquidity issue where people are pulling out their money too fast, will the government step in if it's not going to affect the US economy? Instead, maybe just that small town or region of a state? That is unknown, because the government really couldn't answer. All they said was, at this point, we are helping these banks because of what's going on, but there's a big fear with the regional banks, so you just want to keep that in mind. I still think there's a lot of safety with them, but there is that added risk compared to the big banks. So in conclusion, if you hold less than $250,000 in an FDIC insured bank, you do not need to worry. That's where most of us keep our money. If you have more than $250,000, congrats. You might want to open another account though with a different FDIC insured bank and have two accounts with two different banks that you want to keep those balances below $250,000 just to be safe. It's our hard-earned money, and I think it's always great to protect it. So I just thought this was a good video, as I recently sold out of Bank of America. The bank fears are still high. They're increasing in Europe. There's a lot going on. And I think this adds more clarity and might help you as an investor decide what to do with your own stocks, especially if you own bank stocks or one of these 10 stocks that are at higher risk, one of these 10 banks. So with that said, I hope you guys have a great day. We'll see you very soon on Mark Arnold's Finance.